Hello, everybody. My name is Lindsay Bryan Podvin. I'm the founder and CEO of MindMoneyBalance. And today I wanted to bring on a guest to talk about the more practical side of a series of questions that so many people wonder about, which is student loans. For folks who don't know what you do, could you give us a little rundown of what LoanSense does?
We are a tech-enabled student loan advisory that basically answers all the questions other financial professionals can't. We assign to you a highly trained student loan advisor who will walk you through a comprehensive plan that not just helps with your student loans, but can answer the implications of these student loans on other financial decisions like taking a job, buying a house, what happens to your taxes, what happens if you get married, what is the best time to file. But what the best part of what we do is we not just give you that personalized plan, we help you file and manage your paperwork into the federal programs if you decide that's the best route to take for you.
Which feeds into the next question that somebody wrote in about, which was, I've wondered about the difference between all of the different repayment options that are offered on the government student loan website. For example, the income-based repayment option. It looks so confusing. I'm not sure if it's a trap. I don't know what I'm signing up for, if it looks better now or if it's worse in the long run. Help. I think this question really sums up what it feels like to start digging into trying to research things on your own. And you see one number and you're like, okay, that looks good. But then you start reading the fine print and you're trying to wrap your mind around it. So I guess, could you just help us understand like some of the common repayment options? I think that would probably be the most helpful. They specifically wanted to know about income-based repayment.
Yeah. Okay. So first of all, just to make sure everybody understands, income-based repayment is one type of many different income-driven plans.
Yes.
So I just want to specify that. But income-driven plans are the category of every plan the government has to offer that's based on your income in one way, shape, or form. But it's not just based on income. It's based on your family size. It's also based on your employer status, right? If you work for a nonprofit employer or not. And there's those types of factors that factor into, as well as your marital status. So your marital status and the way you file your income taxes factor also into what plan is best. And every different income-driven plan calculates your interest accumulation slightly differently. I'm not going to go into like every single detail on the different interest calculations. This is what I have to say. The number one pro tip to managing an income-driven repayment plan is if you decide you will enroll, which you can use our help for, but if you decide I want to do this, it is the most vital thing is to always file that paperwork annually on time. Because the number one key to success in these programs is maintaining good standing in these programs. Because what will happen is if you don't maintain good standing and don't file your paperwork, the interest that the government is going to forgive will capitalize, which means it will be added on top of the original amount you took out for your education. And now instead of owing 100,000 and you let 20,000 capitalize, you now owe 120,000, right? And that your daily interest will be calculated based on that 120 instead of the 100.
Oh, wow.
So it's really important that if you make a decision, yes, I want to do this, make sure you're just maintaining into the plan, right? So now directly to answer the question of like, is it good now, but going to harm you later? It will not harm you later, no matter what your decision is, if you want to pay it off faster or get the forgiveness, if you just continue to file into the programs. What harms people is they file into it for a year or two and then stop. And then all the interest that isn't getting paid that's supposed to be forgiven will now capitalize, and now your loan balance will go up. And that is where the kind of catch you, like the government saying catch you, that people hear about that they're so scared about is because people don't maintain the plans properly. But if you maintain the plans properly, it can be highly, highly advantageous because you can get all that accumulating interest forgiven by the government at the end of your payment term, depending on if you work for a nonprofit or a for-profit. Does that make sense?
Yeah, it makes sense. So the second part of this question is, it looks confusing. What I heard you say is, as long as you file your paperwork on time and are making whatever the agreed upon payment is, you're in good shape. Somebody had an additional question, like an add-on to this
Yeah.
question, which is, what happens if I pay more than what's required in an income driven plan?
So what happens is it goes to pay off more of that accumulating interest,
Okay.
which, here's the thing. If you're good about filing your paperwork annually, and if you enroll in our program, we'll remind you when to file your paperwork. We'll also help you do that so that you never get that capitalizing interest. We want to help you avoid that. We will remind you at the 10-month mark from the first time you file. The point is all paying extra does is, as you have that interest accumulating that the government will forgive if you maintain in the program, all you're doing is you're decreasing the amount of forgiveness you're going to get. That's what it's doing. But let's say, for example, you're like, hey, I'm now moving from a nonprofit to a private sector job. I'm going to like almost double my salary, or I'm going to make significantly more money. It does not make sense to, it doesn't make sense to try to get forgiveness because my salary doesn't justify that anymore. It's okay. Still continue to pay into the program, right? Still continue to file into the program and still continue to pay it. So if you make the decision at that point, because you're like, I'm not going to get forgiveness, my salary is too high now, then if you accelerate it, that's good because you're not going to get any forgiveness anyways. But just don't forget to file that paperwork, even if you decide you don't want a plan based on your income anymore, because you don't want any interest remaining to be added to the top of your balance. So it totally depends. If you really want that forgiveness, then no, don't pay extra. Use that money for a long-term savings, retirement. Like if you save for retirement, it will actually decrease your monthly payment. And then you're basically using government programs to fuel your future savings, right? Use it for down payment savings. If you have children, use it for your children's future. Use it for things that will build your assets if you're going towards forgiveness. If you're going to experience significant salary increases and you're not going to get forgiveness, then it's a very strategic decision to understand, okay, I'm going to pay down my student debt, but also recognize that there's a cost. The cost is what you're saving less for retirement, you're saving less for down payment, you're saving less for your children, right? Whatever that decision alternative is, and just understand what that's going to cost by paying more student loans, right? Because one final thought, Lindsay, if you don't mind.
Yeah.
People make such fear-based decisions around their student loans. And the fear is, I just need to pay down my student loans at all costs, right? But they're not thinking about what is it really costing them by making this decision. And I'm going to make a really crazy analogy of a doctor who came to us a few months ago. And I'm only using his analogy because it was so grave. Like his situation was so big because he had so much debt. He basically was like, I freaked out because he got his interest capitalized. So he just started paying off his student loan debt as much as possible. He literally put $100,000 towards his student loans because 50 of it capitalized. He just started acting with fear. And we said to him after doing the analysis, it doesn't actually make sense because you're projected to get 200,000 of your student loans forgiven because he had spent 5 years in fellowship and he only had 2 more years to pay. So why are you could have just gotten that extra 50,000 forgiven anyways. Like, why are you putting all this extra money that you could have ended up getting over 200 in forgiveness? So because of the CARES Act, we were able to help him call his servicer and get that $117,000 back. And he now used that money to buy a house, and he paid 50% of basically 50% down payment on a house.
Wow.
Almost 50% down payment on a house. So sometimes when you make a decision out of fear, you could be costing yourself a lot of money. And maybe if you just step back and got like an analysis done that's more or less fear-based and more of like just a pure economic decision, then you could feel that support. Okay, this is a really good direction for me, right? And this is what I can benefit from and gain. So now he's projected to get that 200 forgiveness, and he now has a house. instead
Wow.
of just putting all his money squirreling away towards the student loans, and he would have no house and he would have no savings. Right. So what is the cost of the decision also has to be thought about.
Yeah.
Is the point.
And Catalina, I appreciate you saying that. And I appreciate that example because in the personal finance space, the dominating message for decades has been debt is bad, debt is bad, debt is bad, debt is bad. So you have all of these people who are paying down their debt, but they're so laser focused on it that they haven't considered where that money could be going if they were really, looking at it from a holistic viewpoint. And I think that's why I was so happy to have you talk about this, because I knew that you weren't going to talk about, you just have to pay off your loans as quickly as possible, no matter what. It's like, no, you also have a life to live. So the next question comes from someone who is trying to make a difficult choice. They say, should I take a low paying job that meets criteria for public student loan forgiveness? The low paying job is about a $45,000 annual salary, and this person's student loans are around $40,000. So I think that's a really good question of, is it worth it to take a low paying job in the hopes that they meet criteria for public student loan forgiveness, or seek out a higher paying job and work on paying those loans without getting public student loan forgiveness? So what's your hot take on this one?
So this is an analysis our student loan advisors help people do very regularly. And I believe I also have a video on this, although it's a little dated in terms of I did it a while ago. But this is a decision our student loan advisors help people make. And I can't give you a blanket yes or no because it's an analysis, right?
Sure.
And this is the analysis of the two things to think about. In a decision, there's always what is the cost of the decision versus the cost of not making the decision, right? You have to balance both, because a lot of people only focus on the cost of making the decision and they don't focus on the cost of not making the decision, which is called an opportunity cost, right?
Right.
So how I think about this is calculate, number one, and you could use our software to start this analysis for completely free because you get that preliminary student loan analysis. Calculate what is your projected amount of forgiveness, right? Number one, over 10 years versus what is the amount of salary gain you will experience over those 10 years. And I know there are projections, but let's say, for example, let's say in this case, if you owe $40,000 of student loans and you make 45, your amount of monthly payment reduction will be fairly low because it's called debt to income. Your student loan debt divided by your annual income is below 1, as in 45 divided by 45 is, I mean, if you make 40, right? Or you make 45, I think that the equation
Correct.
is 45 divided by 45 is 1. So 40 divided by 45 is less than 1. That means that your monthly payment reduction by going on to PSLF is going to be fairly low, which means you have to calculate over 10 years or even this year. Let's say you only know this year, I'm going to reduce my monthly payment from going on an income-based plan or income-driven plan rather, let's say by $100 a month. I'm just going to make it an easy, simple calculation. Yeah. You're going to save $1,200. Okay. That's it. So if your salary, the threshold is super low. So if your salary, if you are foregoing a $60,000 annual job, it's just not worth it, right? Yeah. Whereas some people might have like $120,000 of student loan debt and their reduction will be much, much, much greater. So it's in a matter of calculating how much will I save this year versus how much am I losing by not taking this job, right? And so that's how you make the decision. Understand how much you're saving on your student loans versus how much are you foregoing in that job. Yeah. And for everybody, that number will be different because they're getting different amount of student loan savings and they're foregoing a different amount in their job. Yeah. One final thing I wanted to say, in our economic analysis, we can never account for the pride and joy of doing a job. There is no number we can put to that. So if you say, I will be 10 times happier at this nonprofit job despite earning less than if I went to that corporate job that had me doing this thing I hated, that is not in the economic calculation. You have to almost think about what number would I assign it if you want to include that in your analysis in the nonprofit versus the corporate. For all I know, you might really enjoy that corporate job and not the nonprofit job. So I'm not saying it has to be one way, but just think about that, because that's something an economic analysis can never account for you personally, right? What do you enjoy and what brings a lot of reward to your work? That is very individualized.
I so appreciate both sides of that analysis. One is the numbers side, of course, and then the other is, taking a job that brings you a level of fulfillment. So it sounds like obviously you can't advise based on not knowing all of these things, but in this case, it doesn't make a ton of financial sense to take a very low paying job when, relatively speaking, their loans are pretty low. So the next question is more about life stages. Somebody asked, will getting married impact how much my monthly student loan payments are?
Yes. So I just want to preface wrapping that last question into this question, because they're somewhat related.
Okay.
Is that every single financial decision you make around your student loans is completely individualized. So if you're having a tough time understanding what is this decision going to cost me, or what does this decision mean, I just want to let you know that we're here to support you in making those decisions. So if you listen to this and you're like, I'm not fully clear on how do I think about this for my own situation, just know that we're here to support you. And if you're about to get married or are married, which is related to this question, it's even more complex, because the way the student loan policy and rules work right now is that if you are an income-driven repayment plan and you get married and you file your income taxes jointly with your spouse, their payment will count towards your student loan. So it's really vital to understand, what is the implication of getting married? Does my spouse have student loans? Do I only have student loans? If my spouse also has student loans, then what are the tax implications of filing jointly versus separately if they also have student loans? So there's a multiple factor analysis. Number one, what is the savings to me as an individual versus my spouse? What is our current student loan state? And number two, what is the implications of filing our taxes jointly or separately on our individual student loans, right? And then how we calculate is we think of them combined, and then we do an analysis. What saves more money? Filing my taxes jointly or separately on each of our student loans. And for a lot of people, filing your income taxes separately might actually be more advantageous, especially if your spouse does not have student loans, okay? If you're in a fully amortized payment, which means you're going to pay off your entire loan balance, you're not on any type of special program, then your marriage tax filing status may not be as important. There are some tax implications on how you write off the interest, but that is not made more complex by the marriage tax filing status. Does that make sense? So just to summarize, it's completely individualized, but by entering your information for free in our software, you get that preliminary analysis. If your spouse is also married, if your spouse also has student loans, they can also do that preliminary analysis for completely free. We have what's called a marriage tax calculator. And so we start to do that analysis for you for completely free. If you don't understand what it means in terms of what you should file versus what your spouse files, it can literally mean thousands of dollars of difference, not just you and your spouse's student loan payments if they have student loans, but it can also greatly impact if you try to buy a home together, because that's often what people do. They get married and then they think about family, buying a home. It could also greatly impact how much your mortgage lender says you can borrow on your house. So there's a lot of implications, tax implications, mortgage lending implications. So it's really, really important to understand fully what you're signing up for, not just when you get married, but by repaying your student loans and what plan's best. I hope that helped.